Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance senior reporter Brooke DiPalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. And today we're going to be talking about how investors can position themselves for an AI economy of the future, from driverless cars to personal robots, maybe even flying taxis. And today's guest is bringing some actionable investment ideas, especially from the energy side of AI, which leads us to our phrase of the day: energy infrastructure. Might not have the sizzle of NVIDIA GPUs, but it covers the nuts and bolts plays that are absolutely critical to the AI trade. And for market show and tell, we're going to be talking about dividends, the second cousin of stock buybacks that doesn't get as much press, but can be the key to more stable returns. And this episode is brought to you by the number 250. That's the total power that OpenAI's Sam Altman says data centers could need by the early 2030s. We put that in perspective for all of you Back to the Future fans. And guess what? Today we are welcoming Rob Thummel, who is a managing director and senior portfolio manager at Tortoise Capital, where he has been investing in energy and infrastructure over the last 2 decades. He's been a prominent voice on how AI accelerates electricity demand, saying that electricity is the new oil, which we're going to dig into. Rob, it is great to have you here.
Thanks for having me.
All right, let's begin with your take on how the AI trade is playing out from an energy perspective.
Well, electricity is becoming the new oil, Jared, because if you think about it, we need a lot of electricity. If you think about it, not a lot of people think about when you hit that button on ChatGPT, what really happens. But really what happens is basically it ends up being 2 things: data and electricity. You need 2 things basically for ChatGPT and all AI to function: data and electricity. So the electricity demand in the U.S. has actually been flat for the last 2 decades. That's about to change. It's already changing, but it's going to start accelerating significantly over the next 2 decades. And as a result of that, we're going to need all forms of energy supply sources to generate that electricity.
All right.
Yeah, is this a moment in your career that has stood out to you by chance?
Oh yeah, absolutely, Brooke. Yeah, because it's like the shale revolution. I was around for the shale revolution, and I still think that U.S. shale is one of the probably the most underappreciated, but one of the most significant energy technologies ever to happen, because shale technology allowed the U.S. to become the largest oil and gas producer in the world. It's really changed the shape of the energy sector long term. Now we've got electricity. That's about ready to change the shape of the energy sector for the next couple decades as well.
Yeah, something to look out for. But I do want to get to the phrase of the day. It is energy infrastructure. That's right. That covers the physical systems that produce and deliver energy, from power plants to pipelines, transmission lines, storage, export terminals, and on-site systems. Think about those data center cooling, backup power, and controls. Yes, it is a lot right now, but it all keeps homes, businesses, and data centers supplied with the energy that powers our lives. So, Rob, you've seen this incredible demand really ramp up as of late. From your perspective, what has someone like you, who's worked in this energy sector, likely for years, literally you started out your career within this, what has this been like for you?
Well, it's busy, right? Because it's just trying to figure out how's this all going to come together, right? The energy sector is evolving, and it's evolving very quickly. You mentioned Sam Altman. I mean, we have some of the greatest minds in the world now are focused on this AI and the AI and the future economy. But what people don't realize is, look, there is no AI without infrastructure, as you highlight, and so there's a lot of opportunities for investors, and just figuring out where the best opportunities are. That's what I get to do every day, which is actually kind of fun. But there's a lot to do.
All right, let's talk about a couple names here. Just in terms of the real estate plays, I know there are a couple that you're looking at. One of them is a former blockchain tie-in that's kind of, remaking itself. And we see this a lot in a lot of times companies will just do a makeover and suddenly they can repurpose themselves in a new industry. But this is really interesting, the way you're looking.
No, that's right, Jared. So there's a lot of so AI is transforming a lot of things in our lives, right? But it's transforming companies. You mentioned one. Riot Platforms is a classic example. Yeah, they're going to be blockchain. They're going to do. They have a lot of power, basically. Ultimately, what they started out, they said, okay, we have access to a lot of power. Okay, now what they figured out is, oh, by the way, what needs a lot of power? Well, AI development, AI data centers, and so they're transforming from really being a Bitcoin miner effectively now to a data center operator. They've totally transformed their business from kind of a commodity-based business to a long-duration fee-based business. And so, as a result, the valuation of that stock has increased significantly, and we still think it has lots more room to run.
All right. Go ahead.
I do quickly want to add though, because what sort of investment does Riot need to make in order to make this pivot? Is it underway? I mean, it doesn't just pop up overnight.
You can't just change your name, although that will give you a stock pop.
Those are great observations and questions. What Riot needs to do is they need to build physical data centers. They basically need to build these big boxes, right? I mean,
It seems like a promise though. When does it actually happen?
well, they have a data center. They hired a chief data center officer, I think, who has got a background in building data centers. So they're going to make an announcement, and probably within the next, hopefully in the next few months, where they will give a little more clarity on precisely what they're going to do, Brooke. But I think what they're going to announce is something to the extent of, they're going to build these massive data centers near their electricity generation sources in Texas, and it'll probably be backed by a contract with one of these large hyperscalers. I don't know who, but by probably one of these larger hyperscalers.
Yeah, lots to look out for in this environment.
All right, here's another one. Evergy Corporation, ticker EVRG. I know you're looking at that, and maybe Modine. Just give us some of the things that you see in these companies.
Well, Evergy is the power provider to Travis Kelce and Taylor Swift, if you didn't know that, in Kansas City.
Oh, wow.
The stock goes up, that's it.
So that might be worth something, but it happens to be where I'm from as well. But regardless, I'm not joking about that. But the serious part about Evergy is Kansas City has become an area where there's a lot of data center activity. Well, electricity's, you're going to need a lot more electricity. So Evergy is really an interesting story because for decades it's been a very slow growth electric utility, really boring, and that's fine. That's been fantastic for a lot of investors. It's about ready to accelerate its growth rate. It's another transformation story because what's happening is these data centers are going to come to Kansas City. You need to, they're building facilities, and Evergy's going to electrify or power these facilities. So they're going to potentially double their capacity in terms of electric generation. So that's going to probably result in the growth rate for Evergy rising by about 50%. It's a utility, so if that happens, we think that the stock will re-rate to a much higher multiple, and that'll be good for investors.
I want to break away now, get into some other plays, and this involves dividends. And this is our market show and tell item of the day. We've been talking about these energy plays, and let me just give a quick primer on dividends. They are the cash payments from a company to its shareholders, usually from profits, and they're optional. They're also taxable. You got to watch out for that, and a key part of a stock's total return. And just to emphasize that last part, we tend to talk about stock performance only in terms of what the share price returned over a period of time. Like NVIDIA is up 35% this year. But when we include dividends, that's what we call the total return. And that's a more accurate representation of a stock's performance. You can get apples to apples with that. So tell us about how you approach dividend plays and then just kind of how you think about them in general.
Well, this is something we're really excited about at Tortoise. We've been providing investors with current yield, current income for decades.
And
basically.
energy is a great place for dividends.
That's exactly right, Jared. Energy's been a great place for dividends. And so now, if you can get some income for investors and have an AI component to your potential total return, it's kind of a double bonus, right? And so a company like Williams Companies is a classic example. It's an energy company. It's a pipeline company. Stable, consistent cash flows, because that's what you need, right? You need stable, consistent cash flows to be able to continually pay out that cash that you generate to the shareholders. That's what Williams does. It operates one of the largest pipeline networks in the world. We all need to use more natural gas and have been using natural gas for decades, and we'll use it for many more decades to come. Mm-hmm. Williams also, though, is building electric generation in New Albany, Ohio, to support Meta's Socrates data center there. And so it's called behind the meter. It's a technical term, but it basically means it's not part of the electric grid. So with Williams, you get the dividend yield because of the pipelines and the natural gas flowing through those pipelines and the fees that Williams charges to customers. But then you get exposure to this growth potential because of this electric generation that Williams is building and basically charging Meta now a fee to generate the electricity from the natural gas that Williams transports into these various facilities.
Yeah. Go ahead.
Just quickly, if you're a first-time investor and you're looking at a dividend stock, what's the timeline look like to sort of hold that sort of investment?
Now, that's a good question, Brooke. I'd say forever, right? If you get a good dividend yield. Now you have to make sure that dividend's covered. That's a very good question, though. I mean, the timeline is forever if you're confident, if you can gain confidence that dividend's going to be consistent for decades, or I don't know about forever, but let's just say forever. And if they can grow that dividend, that's another important thing. So we spend a lot of time, analyzing the companies, their historical returns, how volatile their cash flows are, because companies that have more volatile cash flows, well, they're less likely to maintain steady, consistent dividends.
Right.
Less volatile cash flows typically mean more steady dividends.
And I just want to highlight all the viewers out there, you can find all the dividend information for various stocks on the Yahoo Finance site. And you mentioned a key stat, the dividend yield, and that is the dividend as a percentage of the stock price. So you can think of it almost as an interest payment that you might receive from a bond. So what do you look for in terms of dividend yield, and how do you find those that you feel confident in are going to be able to make that dividend payment in the future, as you said, maybe forever?
Yeah, well, we look at the nature of the revenue growth. We look at the nature of the business. You got to really look at the assets, right? Do these companies, Warren Buffett likes to talk about economic moats. That just means how stiff is the competition for the business, and how easy is it to replace these businesses or these assets that are generating the cash flow that are paying these dividends, right? And if you have these wide economic moats where it's very difficult, if not impossible, to replace the assets, then you can feel pretty confident that the cash flows that underlying asset or that underlying company is paying are probably going to continue to be paid for a long period of time, maybe forever. And so that's really what we look at. Who has the largest economic moat? A lot of times infrastructure assets really fit in that mold because they're real assets,
and they don't have the competition is difficult.
And they have these moats because and sometimes they're regulated. Even a lot of regulated companies have pay high dividends. Utilities pay a lot of high dividends just because, and they're regulated. And they have regulated returns. You can feel pretty good about those type of businesses.
Yeah, we need to take a short break, but we're coming back. We're talking some jaw-dropping numbers when it comes to AI power needs and a runway showdown that pins your golf skills against your poker face. Stay tuned. This episode is brought to you by the number 250 gigawatts. OpenAI CEO Sam Altman recently got some attention when he said that this is just how much power that data centers will need by the early 2030s. That's pretty soon, right, guys? For those tracking, that's about 1/5 of the current U.S. capacity. Now, Rob, these numbers just keep getting bigger, but this all projected growth, are these numbers really realistic if it's just this projection that these big executives are putting out here?
Yeah, well, I think Sam Altman probably knows.
Right.
I think the thing holding back AI development, Sam Altman and other tech executives have said the same thing. What's holding back the development? It's not the computing power. It's not the brilliance of Silicon Valley. It's the electricity supply, and and so I think those numbers are real. It's massive, though. You highlighted, Brooke. It's a massive.
It seems scary. It's only 6 years away.
I mentioned Back to the Future in the intro because if you remember that point in the movie where Doc Brown says 1.21 gigawatts, and he calls them gigawatts. Okay, this is 200 times that amount. Right. And so, Rob, you and I were talking about something before the show, which is this kind of a mirror possibly of what happened in 2001, where you had all this fiber optic buildup because the internet was a new thing, and suddenly everybody had to have these pipes. Well, are we in danger of having an overbuild here?
Yeah, I mean, I think that's always something to watch. I don't think so because I do think that the technology is there, the cash flow is there. The difference I think this time is these big hyperscalers, mega cap tech, they've got a lot of cash flow.
And they're paying it out of cash, not debt.
Yeah, exactly. And they've got $250, $300 billion of free cash flow just this year, and that's after they spend $400, $500, $600 billion on all this data center. So there's a lot of cash here that they're generating right now. Earning a return on that cash or on that capital is going to be something we're going to watch pretty closely, and obviously the boards of these companies are as well. But yeah, I think it's real. I don't think we'll have an overbuild. It's always something to keep an eye on. But we're a little ways away from that. Maybe 5 years from now, it's a discussion to have. But right now, everybody needs more electricity, and they need it now.
Yeah, and I do think what spooks me, though, is we're getting these notes from, say, Bank of America, and they're saying that at the end of the day, the consumer will ultimately be paying up for these build-outs, for this rapid demand of capacity. What do you make of those sort of suggestions?
And the not in my backyard movement, because nobody wants those elevated prices.
They don't. No, well, so and that's something, obviously, that all the constituents, and including the data centers and the electricity power providers, want to avoid. So there's a couple ways to do that. So there's some of this behind-the-meter power, and I mentioned that with Williams. That solves that problem because now those data centers that Meta's building in Socrates in New Albany, Ohio, the residents of New Albany, Ohio are not going to pay for that power.
Yeah.
Instead, who's going to pay for that power? Well, it's going to be Meta who's going to pay Williams basically a fee, right?
Right.
And that's called behind-the-meter power. So Meta will pay Williams, and the consumers will not have to pay. In addition to that, there are some rate structures by these utilities whereby when you are a large user of electricity in a specific area. Evergy is a classic example. I'm not going to have to pay for that power. Travis and Taylor aren't going to have to pay for that for those data
Other
centers.
Kansas City residents will not have to pay for their
No, they don't have to either. Travis could afford it. Taylor could as well. But that said, it's going to be charged to the large load, the data centers who are actually using that power. So they're going to get charged a special rate. It's a little bit nuanced, it's complex, but the bottom line is the utilities, the companies, everybody's very well aware that the retail consumer doesn't want to see higher power prices so that they can build these massive data centers and all these technology gurus in Silicon Valley make all the money off of it while it's funded by everyday people like ourselves. And so that's something that everybody's keeping an eye on.
Yeah, you could imagine that becoming a very hotbed election issue over the next few years. Maybe not necessarily this November, but going forward. I want to ask you about pure play natural resources, and just take gold, for example. Now, gold isn't really part of the AI trade, but silver might be. And we've had these parabolic moves, and you could also put in maybe natural gas or crude oil at different times. Do you ever play those material resources, maybe through an ETF or in the futures market?
Yeah, well, I think what we think going forward is, if electricity is the new oil, natural gas and nuclear are going to be the future energy supply sources. So we're at Tortoise in particular, we're interested in natural gas and the opportunities there. Buying the direct commodity, not so much, but you can buy companies like EQT and Expand Energy, who are the two of the largest natural gas producers in the U.S., and they typically trade in line, generally speaking, with what the commodity price does.
Okay, interesting. Anything we haven't covered here in terms of sectors that you like or part of the data center trade? I mean, it could be cooling systems or whatever.
Yeah, Jared, that's well, we love the enablers, right? So the infrastructure that enables all of this AI development. So those are companies that produce data storage devices, right? So those are companies that also do the cooling. You're right, the heating and the cooling. That's really interesting to us as well. The cables, all of that kind of stuff. The network switches. Those are all examples of companies that are going to have significant growth tied to this data center build out, because these data centers are getting massive. They're getting bigger. Meta's going to build data centers that are the size of Central Park. So you need a lot of infrastructure and a lot of AI and network infrastructure that really enables the development of AI.
Really interesting to see some of these companies, maybe a century old, who have just totally reinvented themselves here. But we've got to take a little bit of a diversion here. We've got a classic market take on a Hollywood gab show staple, which we call Who Wore It Better. Today's theme stacks up a golf strategy and a poker strategy. It's read the green versus read the table. On the left catwalk, struts read the green. For a put, you study the slope before you swing. And in markets, that means studying the business, how fast demand is growing, what it costs to keep the lights on, and whether cash flows can support those dividend payments over time. And on the right catwalk, we've got read the table. Before you bet, you watch the players. And in markets, that would be the crowd. Are investors already piled in? What's investor sentiment looking like? Is the exuberance? Is it too rational? Both matter. Fundamentals can tell you what to own, and the crowd dynamics can help you on your position, deciding when to pounce. For this market, Rob, which skill wears the current market environment better? Is it reading the green or reading the table?
Oh, I think it's reading the table.
And here we are. So let's make our bets here. Tell us how you would use that information, how you read the table, investor sentiment if you're trying to get into a stock or out, or
yeah, there's a lot of momentum, right? There's always momentum stocks, right? And you can kind of see that in daily trading volume. So you can see, you can use technical analysis, things like the 50-day moving average versus the 250-day moving average, and look at technical analysis to see when a stock crosses over its 50-day moving average, or the current price is above its 50-day moving average or below it. So there's a lot of things like that where you can get a sense for, are the masses buying or are they selling?
Yeah. So more tactical. And I'm just wondering in general, what are you focusing on right now? Is it more of the long-term bets, or are you spending your days trying to figure out how to kind of navigate some of the ins and outs in the day-to-day management?
Well, yeah, at Tortoise, we're probably more reading the putt. You're right, Jared, because I mean we're studying the cash flows. We're fundamental investors at the end, ultimately, and we look at every single stock and analyze its cash flows and project its cash flows, and that's why we like this AI infrastructure trade. Because if you look at the growth potential and the cash flow growth potential of a lot of these enablers of AI, it mirrors really the capital spending growth that you're seeing out of these hyperscalers. So if we're going to go from $600 billion today of hyperscaler CapEx spending to what Jensen Huang says could be maybe $3 to $4 trillion by 2030. That's
Another jaw-dropping number?
Not a jaw-dropping number, no, but it's 30 to 40, that's 40% annualized growth between now and 2030. Well, that same growth, that money is being spent with these AI enablers, right? It's being spent with the data storage device companies that manufacture those. It's being spent with the network switch operators. It's being spent on cabling. And those companies that perform those services and provide those services are growing at the same rate as this CapEx spend. And so that's kind of more reading the putt, I guess, maybe than going with the masses, right? So
for investors, though, who see this market and they see all this frothiness, all these high market valuations, they really see this big trade around the AI demand. How do you sort of understand when and where to get in right now?
Yeah, well, so that's a great question, Brooke. So we've looked at this really closely because, there's a big question out there about, are we in an AI tech bubble? And we don't think so, because when you look at the previous bubbles, we look at the price earnings ratio, right? So have the stock prices went up faster than the earnings. And so are the earnings not there to support the rise in price? And when that ratio gets really high, that would mean maybe we have close to a bubble. I think in the tech bubble, the price earnings ratio of the S&P 500 was 171 at one point in time.
Eye-watering.
Yeah,
it
as
is.
we say.
It
That's
is.
insane.
It's not. We're nowhere close to that now. We're in the 30s, right? And so what that tells me is the earnings. Yeah, the stock prices have done phenomenal, but the earnings have kept up, right? So, because the price earnings ratio really hasn't changed much. So the earnings have kept up with the stock price performance. So, but that's really the one thing that we look at. And we like to find stocks, obviously, that have low price earnings ratios, but growing earnings rates. And so then maybe you can get them at a cheaper price and then derive some return from that.
And certainly we've seen investors flock to these stocks after their earnings have proved otherwise.
All right, and we're going to have to leave it there, but just kind of backing up for a second, I like how we led into this whole discussion with the energy infrastructure trade at large, looking for kind of pockets of investment opportunity outside some of the glam and glitz that you might hear about NVIDIA in your daily financial music travels here, and also dividends. Something I've kind of overlooked over the years, but I've recognized the importance of them. It's nice to have that cash flow, and especially if you can reinvest those dividends, well, then you get compounding magic, and that's something that Warren Buffett talks about. Just in terms of the numbers, they're just astronomical, and I've been asking a few different guests here what their take is. Are we in an overbuild stage similar to 2001? Almost everyone has the same answer, which is no, and that we are not supporting this CapEx, these expenditures with debt. We're doing it with good old-fashioned cash, which has been earned the old-fashioned way, which is earned. And on that note, I'm going to leave it there. So we are winding things down here at Stocks in Translation. Be sure to check out all our other episodes of the video podcast on the Yahoo Finance site and mobile app. We'll see you next time.